Hey everyone, and welcome to a brand new explainer. I am absolutely thrilled you're tuning in because today we are unpacking a monumental shift. The date is June 6, 2026, and we're diving deep into Kingfinity's latest insights on building treasury-backed digital capital systems. For the longest time, the whole digital asset space was judged entirely by noise, by sheer velocity, and by spectacle. But that era? It's fading, and something far more durable is quietly taking its place.
Okay, let's dive into this. We are literally leaving behind the era of spectacle, the phase driven by pure hype, short-term attention, and high-speed trading. What's emerging now is the era of infrastructure. The market is seriously maturing into a phase that's defined by enduring architecture, the ability to scale globally, and seamless integration. So the most relevant question is no longer what's trending today, it's now what can integrate and what can actually endure. Attention is shifting away from that visible, loud excitement and toward invisible, rock-solid architecture. If you're only looking at surface-level market price sensitivity, you're going to completely miss the bigger picture here. Because right behind the scenes, institutional and payments infrastructure isn't just holding steady, it is actively, aggressively advancing. We're witnessing a total reframing of digital assets. They aren't just instruments for short-term attention anymore, they're becoming critical tools for financial coordination at a massive, global scale.
Okay, Section 1. Stablecoins become operating rails. To see what this actually looks like in practice, just look at MoneyGram's move into MGUSD. This is huge. It's not about speculative positioning or isolated crypto trading. They explicitly designed this to support real treasury operations, global settlement, and massive FX workflows. And honestly, this is exactly how infrastructure enters the mainstream. It doesn't happen through loud noise. It happens through undeniable, everyday usefulness.
Which, of course, begs a massive strategic question for us. Will stablecoins become the absolute preferred digital liquidity layer for moving value globally? Looking at the board right now, the pieces are definitely being put in place for exactly that.
Moving on to Part 2. Exchanges evolve into infrastructure.
And this brilliantly illustrates the shift we're talking about. Exchanges are no longer just standalone destinations where you go to trade tokens. The partnership between Kraken and MoneyGram reveals something much deeper. They are enabling seamless crypto-to-cash global withdrawals across a massive worldwide network. And similarly, Coinbase rolling out direct Indian rupee rails to integrate natively with local financial pathways, that is a game changer. Exchanges are embedding themselves directly into broader financial workflows, wiring digital markets straight into real-world money movement.
So, think about this for a second. In the next cycle, will Axis actually outperform Brand? If the whole exchange story is no longer just about daily trading volume, the winners won't necessarily be the ones with the loudest community on social media. The winners are going to be the platforms with the absolute strongest, most deeply embedded distribution architecture.
All right, Section 3. Policy catches up. We're talking regulatory maturation.
Behind the scenes, treasury frameworks are basically becoming a highly visible layer of trust. Just look at Coinbase's support for reserve-related cash management infrastructure, or Circle's deep, treasury-oriented work with Kyriba. Treasury design is no longer this invisible back-office thing. Moving forward, it simply won't be enough to just launch a flashy product. Ecosystems are going to have to prove their discipline, their reserve integrity, and inspire confidence through solid, verifiable structure. Which leads us to wonder, could treasury transparency actually become one of the defining luxuries of serious digital ecosystems? As any platform scales and becomes systemically visible, community signaling and hype just aren't going to cut it. True operational credibility and crystal-clear treasury design, that is what's separating the serious builders from the noise.
Part 4. Two new monetary architectures, the rise of parallel systems.
We are literally seeing the development of two entirely new parallel monetary architectures being built out at the exact same time. On one side, you have open stablecoin rails, these public, crypto-native liquidity layers. On the other side, bank-linked tokenized deposit rails, institution-led systems completely focused on wholesale cross-border payments. We've completely moved beyond that old, tired crypto versus banks debate. We are heading toward a layered reality where trust, usability, and true interoperability will determine which system actually handles global settlement the most efficiently. But here's the real kicker. Will future users even care which of those two systems they are using? Or will they only care whether it works beautifully? The best infrastructure in the world is characterized by frictionless coordination. It's that invisible complexity that the end user literally never has to think about.
And that brings us to Section 5. Interoperability is the ultimate premium layer.
So obviously, having multiple parallel systems brings up the ultimate challenge of this new era, and that is fragmentation. But when you look at the recent updates from the BIS on Project Agora and Swift's massive emphasis on interoperability, the signal is absolutely impossible to ignore. Heavily regulated legacy institutions are actively getting their hands dirty with coordination layers. Tokenization and programmable settlement have officially moved out of the crypto-native experimental sandbox and are now squarely sitting as structural priorities for the entire global financial system.
So the crucial point is this powerful thought: connectivity is becoming a form of power. In a world where digital systems are multiplying so rapidly, the absolute highest value infrastructure won't necessarily be the one that hoards the most assets. No, the true elegance of a premium ecosystem is going to belong to the infrastructure that can seamlessly and effectively connect the most environments together.
I want to leave you all with this final provocative thought today. Are we literally watching the early convergence of legacy finance and digital infrastructure? We have definitely moved past the era of loud, empty claims and into an era that absolutely demands clear utility, resilient treasury logic, and seamless connection. The durable architecture of the future is being built right now, quietly but powerfully, right in plain sight. Keep your focus on the architecture. Thanks so much for joining me on this explainer, and I will catch you next time.